If you've ever felt overwhelmed by investing, this video is going to feel like a relief. Because index funds are the closest thing investing has to a default setting. No hype, no stock picking, no pretending you can predict the future. Just a simple idea. Own a tiny piece of everything, keep costs low, and let time do the heavy lifting. Today I'll explain what index funds are, how they work, why they beat most clever strategies, and how to use them in a real-world portfolio. And quick note, this is educational, not personal financial advice. I'm not telling you what to buy, just how this works so you can make smart decisions. All right, let's start with the definition. An index fund is a fund designed to track a market index. An index is basically a list of investments that represents a market or a segment of a market. For example, an index might track the biggest companies in the US, or the biggest companies in the UK, or a global basket of companies across many countries. So when you invest in an index fund, you're not trying to beat the market. You're trying to be the market. That's the entire philosophy. Instead of asking, which company will win, you're asking, how do I own the winners, without needing to know who they are in advance? Because here's the uncomfortable truth. Most people, including most professionals, aren't good at predicting winners consistently. Now, how does an index fund actually work? A fund collects money from many investors, then uses that money to buy the underlying investments in the index. If the index is weighted by company size, meaning bigger companies take up more space in the index, then the fund also holds bigger positions in those bigger companies. So if Apple or Microsoft or some huge company grows and becomes a larger part of the market, the index fund automatically ends up holding more of it, without you doing anything. And if a company declines and shrinks, the fund naturally reduces exposure over time. This is what people mean when they say index investing is self-cleaning. It adapts as markets change. That's why index funds are considered boring. They're not trying to be clever. They're just tracking reality. Now the obvious question. If it's so simple, why doesn't everyone do it? Two reasons. One is psychology. People want to believe there's a shortcut. They want the hot stock, the secret strategy, the fund manager with the magic touch. The second is incentives. The investing industry makes far more money selling you complex products than it does selling you simple ones. Index funds are boring, and boring is cheap, which is exactly why they work. Let's talk about costs, because this is one of the biggest reasons index funds win. When you invest, your returns are shared between you and the financial industry. The more you pay in fees, the less you keep. And fees aren't just a small nuisance. Over decades, fees can become a wealth destroyer. Here's the key idea. Investing is a compounding game, and fees compound too, but against you. Even what looks like just 1% per year can translate into a huge difference over 20 or 30 years, because every year you're taking a slice out of the growth you would have compounded. Index funds are usually much cheaper than actively managed funds, because there isn't a team of analysts trying to pick stocks and trade constantly. Index funds follow a rules-based approach. That makes them simpler to run and cheaper to maintain. And this brings us to the second major reason index funds win: performance. Over long periods, many active funds fail to beat their benchmark after fees. And this is not necessarily because active managers are stupid. It's because the market is extremely competitive. Think about it. If you're trying to beat the market, someone else has to underperform the market. Before fees, active investing as a group is essentially a zero-sum game, because everyone collectively is the market. After fees, it becomes a negative-sum game for active investors as a whole, because the costs have to come from somewhere, and that somewhere is your return. So index investing is essentially choosing to accept the market return, and avoiding the extra drag of trying and paying to beat it. Now let's make this practical. There are different types of index funds, but most of them fit into a few categories. First, broad market index funds. These track a wide group of companies, like an entire country's stock market or even the global stock market. Broad index funds are the core building blocks for most boring investors because they provide diversification across many companies and often many sectors. Second, regional or country index funds. For example, a fund tracking just the UK, or just the US, or just Europe. These can be useful, but the risk is concentration. If you invest only in one country, you're making a big bet that this country will outperform the world. Sometimes it does. Sometimes it doesn't. And you don't need to guess that correctly to become wealthy. You just need broad exposure and time. Third, sector index funds. These track a specific area like technology, healthcare, energy, or financials. These can be tempting because they feel like you're being smart, but they're basically a concentrated bet. They can have big wins and big drawdowns. For most people, sectors are not a starter move. They're optional and usually small if used at all. Fourth, factor or style index funds. These follow an index built around rules like value, quality, small cap, or momentum. Again, these can be valid strategies, but they're more advanced and can behave differently from the broad market. They also require patience because they can underperform for years. If you're building a boring long-term plan, the easiest place to start is broad market exposure, often global. Now let's talk about the biggest advantage of index funds: diversification. Diversification is the idea that you reduce risk by spreading your money across many investments. If you own one stock and it crashes, your portfolio crashes. But if you own thousands of companies across many industries and countries, no single company can wreck your plan. Index funds make diversification easy because one fund can hold hundreds or thousands of companies. And diversification doesn't mean you never lose money. It means you reduce the chance that one bad outcome wipes you out. That's the whole point. Now, let's address a common misunderstanding. People sometimes say, index funds are safe. They aren't safe in the short term. If the stock market drops, a global index fund will drop too. That's normal. Index investing is not a way to avoid market crashes. It's a way to survive them. Because the real risk for most people isn't volatility. It's behavior. It's panic selling. It's constantly switching strategy. It's chasing what recently went up. Index funds support good behavior because they remove the feeling that you need to react. They give you a plan that you can stick to. And sticking to the plan is where the results come from. So how do you actually use index funds? Here's a boring framework that works for most people. Step 1. Pick a simple core. For many investors, a global equity index fund can be the core, meaning it's the main engine of growth. Step 2. Decide how much risk you can actually live with, not how much you think you can handle. How much you can handle when markets are falling and headlines are screaming. If you're young, investing for decades, and you can ignore the noise, you'll typically hold more in equities. If you're closer to needing the money, or you know volatility will cause you to panic, you may want a mix that includes bonds as a stabilizer. Index investing isn't just about which fund, it's about the right asset mix for your life. Step 3. Contribute consistently. This is where boring investors quietly win. Regular contributions mean you buy more when prices are low and less when prices are high, without trying to time anything. This smooths your journey and reduces the temptation to wait for the perfect moment. Step 4. Leave it alone. The magic of index funds is not constant tinkering. It's compounding. You don't need a new plan every month. You need one decent plan for years. Now, let's tackle a few objections people have. Objection 1. If everyone buys index funds, won't the system break? You'll hear this online sometimes. It sounds clever, but in reality, active investors still exist in huge numbers, and price discovery still happens. Even if index investing grows, markets don't suddenly stop functioning. And practically, You're not investing for a hypothetical extreme future. You're investing to build wealth in the world we actually live in. Objection 2. Index funds can't outperform. Correct. And that's the point. If your goal is to get rich reliably, you don't need to be exceptional. You need to be consistent. Index funds aim to capture market returns at low cost. That's a very high bar over decades. Objection 3. It feels too easy. That's the trap. The best investing strategies often feel too boring to be true. But boring works because it's repeatable. It's low fee. It's diversified. And it doesn't require you to be right all the time. Now there's one more important concept: tracking error and fund quality. Not all index funds are identical. Some track very similar indexes, but their fees differ. Some might track a narrower or broader index than you realize. And some are synthetic, using derivatives rather than physically buying the underlying shares. None of these are automatically bad, but you should know what you're buying. Read the fund's objective, check what it tracks, and understand the fee. You don't need to become an expert. You just need to avoid surprises. Now let's wrap this up. Index funds are the boring investor's best friend because they let you own the market, diversify widely, minimize fees, and stay consistent. Stocks build wealth over the long term, but they're volatile. Index funds help you own stocks in a diversified way, so you're not betting your future on a handful of companies. The biggest enemy of the average investor isn't lack of knowledge, it's lack of consistency. Index funds are designed to make consistency easier. In the next video, we'll talk about the active funds. If you want the boring path to getting rich, subscribe. Because here we keep it simple, we keep it low cost, and we keep it long term. The boring investor wins.